All right, good morning. Today is Thursday, May 21st, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as our different social media pages. If you are with us live or if you're watching in the recording, thank you. Pat yourselves on the back for taking some time out of your busy schedule to be here with us today. If you are new here, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team, Ann Colian, Josh Denny, and Karen Miller. Together, our goal is to help individuals, couples, and families make their next financial decision and the one after that a good one. And one of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we're seeing, and ultimately to be a more informed investor. So we do this in two ways. First, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you'd like to learn more about this after today's message, head on over to clearfinancialfuture.com. Watch the very brief 2-minute video. And then secondly, we help our clients get invested right. And being invested right is unique to every single person that we serve and every account that we manage. And SmartMix is our process for doing so. So whether you have $25,000 or $25 million, SmartMix is our process for helping you as an individual get and stay invested right. After today's message, if you'd like to learn more, head on over to smartmixportfolios.com. All right, so today we are going to hear from our guest speaker, Tom Fox. Tom is managing partner and chief investment strategist with Water Street Research Partners. And as always, I am very excited to have him here with us today. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has over 35 years experience building investment strategies. He has an impressive long resume, as you can see on the screen. And so I'm always excited to have him here with us. At the end of today's message, we will have some time for Q&A. So if you're watching online, whether you are live today or you're watching in the recording, please feel free to ask any questions. You can email me, you can text us at our office number, or you can comment below in the comment section, and I will see those questions and I will get them to Tom. So with that, the agenda for today, as I bring Tom onto stage, our agenda, Tom will cover the headwinds in the markets and the economy, the positives, and give us his outlook. So good morning, Tom. Welcome.
Good morning, Eric. Good morning, everyone.
Thank you so much for being here. I will bring our theme for 2026 up, which most everybody better know by now, but things have changed.
They have changed.
Change, actually. So,
and undergirding that change is one of the biggest revolutions we've ever seen, and that is AI.
Yeah, absolutely. It sure has been all the talk, hasn't it?
It's amazing, and we're at the early innings, so things have changed. Companies throughout the U.S. and around the world are beginning to employ AI, and it's gonna transform many economies.
Yeah, very exciting times for sure. So let me progress us right here. All right. Let's get the bad news out of the way.
You want the bad news out of the way, but why don't we just stay on this page for a while, Eric? Now, we always like to list all the different things that we need to be concerned or worry about. Number one is the energy-driven inflation risk. We've had rising oil, diesel, and also fertilizer, and these are all input costs. And eventually everything moves from energy, and there's a transportation, there's all kinds of costs that are related to energy, which could impact the prices. And we've already seen that in the PPI and the CPI-2 inflation gauges. But this needs to be settled very soon in the Iran deal. We'll talk more about that. So as a result of that, the Fed, which was, remember, early on this year, was expected to lower rates 2 more times this year. Well, that's completely been tabled because one of their mandates is inflation. The other one is employment, and employment's staying steady Eddie. So there's no reason for them to cut rates right now, especially with the higher inflation potential. And it could, we don't believe this will happen, but some are saying maybe they'll begin to raise rates again. And of course, that would have a very negative impact on the stock market. Another thing is that the last 4 Fed presidents, 3 of those 4, when they became Fed president, encountered a recession. Not a recession, but we ended up in a correction in the stock market. One of them had a positive return. The other 3 had negative returns. We'll look at a graph on that. So sometimes when there's a new Fed chair coming in, we got Kevin coming in to be he's been announced as the new Fed chair, that can be some negativity there for stocks. The other area is the May-October window, especially in midterm years, produces the weakest returns. And sometimes there's big drawdowns, sometimes there's policy uncertainty and volatility peaking into the November elections. However, we'll see in a chart, and we'll also see in the positives, that once you get past the election, markets tend to rally. But we could have some weakness between now and the election. The typical geopolitical risk is out there, and this is the big one. When is this going to get resolved? Is it going to get resolved? So the Iran, if it drags on, it's just going to trigger further market shocks. So we're kind of running up against some dates. We'll look at a chart on oil inventories and a couple dates that are key that this whole war needs to come to an end. And hopefully that happens. Nobody knows the answer to this, but it is a concern. But today we're okay at this point. We'll see what happens over the next, even this week or next week. So you got the geopolitical risk. And then you got the world oil inventories. We'll look at that. September, it reaches a point where a floor level, that the minimum level to keep pipelines and refineries operating, begins to go away. So this is a big issue, and hopefully this gets resolved very soon. Now, we could also have consumer weakness could emerge. Now, we know in lower incomes, it's already an issue. It's already impacting their spending, but most of the spending is done in the middle or upper middle to the wealthy. So that they're not moved too much, but it's in the lower income. This could be a problem, but there could be a big shift. If inflation keeps rising, credit cards keep rising, savings lowers, we could see a shift in consumer weakness, which obviously would hurt the overall economy and also hurt stocks. Another thing is the debt that's growing and our deficits and our budget. We'll look at a chart on that, but long term, this isn't typically a short-term issue, but long-term, it can bring down the road instability. And of course, we have investor sentiment can reverse quickly, especially when you're at a strongest peak. A sharp shift in confidence or earnings expectation or liquidity or whatever could trigger a major correction. And we've already had one this year. We may have another. We don't think that's outside of the realm of possibility. But we expect that we'll see where we're long term for the rest of this year, where we think we're going to end up. So you also have late cycle. We're getting longer in the tooth in this bull market. And of course, it could limit upside. It could begin to change direction. But we'll be watching for that. That's the list of worries. But there are many positives why we should own stocks. And here's the biggest one. Earnings are spectacular. Earnings resilience, rising revisions. We'll look at charts on this. They continue to grow. I mean, they're beating expectation by a high percentage, supported by strong margins, pricing power. And here's the other, analysts' revisions are on the upswing. They're raising their outlook for corporate America. This is all good news for the stock market because ultimately it's earnings that drive stock prices. The other thing, of course, we talked about at the beginning is AI-driven productivity, which is at the beginning innings. Companies are going to become more efficient, more profitable. I'm very bullish long-term on how AI will impact stock prices in the future and in the economy. So we're only at the front end of this, and it's beginning. Companies are beginning to now increase the use and learning how to use it for each of their unique situations. So this is really going to translate into more revenue, more profitability on the road, which is very bullish long-term for the stock market. And then the economic durability, despite all the stress we're having, consumer spending continues, employment trends are solid. So we haven't seen any deterioration in the economy, and we're going to keep an eye on that as long as that holds. So if you have earnings and the economy hanging in there, and that's a good sign for stocks. Strong balance sheets, corporations entered this period relatively low leverage. They had to get lean and mean during the pandemic, so they reduced their costs, and of course now revenues are taking off in many industries. So this is all positive for their balance sheets, and of course global magnet right now. The U.S., even China said we're the hottest place. So many investments are coming our way, which helps employment, helps the U.S. So we have liquidity, we have innovation. Our rule of law makes it an ideal location for foreigners to invest. And we're seeing a lot of new investment coming in, especially because of this administration. And then here's the big one. Remember, everybody remembers the dot-com when technology fell to the floor, 60, 70, 80% down. But current valuations rest on actual earnings, not pure speculation. Dot-com was speculative. We see substance behind the valuations today. And so it's real revenue, it's tangible productivity gains we've been talking about. So this is all good. And especially our innovation, we're heavily weighted towards leading companies in technology, healthcare, industrial innovation. The future is very bright for the United States, in our opinion. And there's a lot of really good, solid companies that are forward-looking. And of course, AI is just going to amplify all of this. Here's another one. There's over 7 trillion in money markets, Eric. That's a lot of money. It's been growing. Well, what happens if that money decides to come back into stocks instead of earning lower and lower yields? Well, that could be, there's a lot of dry powder there, gunpowder, to cause this market to move very fast upward. And if we get a settlement to Iran, this market, I believe, will begin to rally in a big way, even though it's been already hitting highs. We've had a little pullback, but we'll see what happens here. Hopefully we have a good outcome there. And most bull markets last 5 to 7. We're only in the 4th year. So if history favors a continuation that will deliver another year of positive returns, and that's where we are. You'll see that at the end. So staying invested through volatility historically beats market timing. Corrections are in healthy bull markets tend to be buying opportunities, not exit signals. And we think this is all positive for stocks.
Excellent. Well, I always appreciate your overviews, but I also really like getting into the weeds. So let's look at some charts here.
All right. Well, some of these bullet points we just looked at are in some charts. Now let's look at recently. Stocks pulling back. We had 4 days, a 2.5% drop. Now Yesterday it rallied. Today it's kind of mixed. We'll see where it ends up. But let me look at it right now. Slightly down, not much. But we've had a pullback in this particular run the last 4 days. And what's driving that recent pullback? We can look at this in the next chart. There's two things. These are the drivers that can bring down the stock market. And that is oil prices, which are at a 1-year high, and their 10-year yields, the treasury yields, interest rates are rising because now there's worry, again, as mentioned in the list of worries, that the Fed may raise rates. Now that's a minority view. We don't agree with that, but we've hit a 4.7 on the 10-year, so that's been surging. Remember, it was almost below 4% earlier this year, and of course the two cuts are taken off the table, and now everybody's worried about that impact of oil prices impacting inflation, which impacts the treasury yields. So if let's say the 10-year yield reaches 5%, we don't think it will, but it's a possibility. Well, then there's competition for stocks. And that's one of the reasons we've had a recent pullback. But why are we near all-time highs, Eric, with all this going on around the world, in Iran and so on? Well, because markets still believe that oil will be back at $80 later. You can see it following off at the end of this year. They're still expecting. This is the futures of oil. You can see it drops down to normalizing again. This is why people believe this is transitional, temporary. And obviously the oil prices, if they come way down, that's going to lower inflation in the future. So this is an interesting chart. This is one of the reasons we keep bumping up against new highs, even with all this going on, this chaos around the world. Well, here's the big one. And this, again, drives everything. But the corporate earnings this last quarter were spectacular. You can see 91% reported when we put this up. 86%, Eric, have beat their estimates. But look at how 17.9%, that is massive. I haven't seen that number that high. What's happening? Corporate earnings are blowing it out. And we think it's partially AI, but I think this is going to continue. We'll see in another chart here coming up. But you can see that these are spectacular. That's why the market's reaching new highs, along with the transitional oil pricing. This is by BlackRock, but you can see that what was the revisions? Downward, below, minus, or positive? You can see in 22 it was up, but look at 2026, how fast the analysts are raising their expectation. They're revising earnings upward. This is a very forward-looking view, which means that we have great quarters potentially coming as we head into the next rest of this year. So this is a very positive chart showing how the revisions have been amazing.
Yeah, that's quite the rise.
And of course, this is the market's anchor. This chart shows the relationship since 2005 with forward S&P 500 earnings and then the pricing. Well, you can see they follow each other. So at the bottom line, earnings drive stock prices. Now, not only is it happening in tech, which is, you can see the first quarter, how tremendous year-over-year growth for tech companies. That's the black bar. And then you see the yellow bar is the rest of it's the Mag 7 versus the 493, excuse me. But you can see that the expectation for the calendar year, both are rising. And we think AI adopters are a part of this, where AI is getting into helping companies in different industries. But you can see that the earnings growth is tremendous for technology. We do have an overweighting in technology. And this has been a great time to be heavily weighted towards tech. You remember the beginning of the year, it shifted to value stocks. Well, it's rotated back big time to growth. Now, this is showing the profit margins. Look at from 23 and to the 26 estimates. Eric, look at the angle that is going at. That the blue line is technology companies. You can see their profit margins are growing, but also we expect that there's going to be profit margin growth in the rest of the companies outside of technology. It's still not as much, but technology, we believe, will lead the future here for the rest of this year. Now, how about valuations? So this is an interesting chart. By the way, NVIDIA just came out with their earnings, and they beat all the way around. But look at the price. It's gone to 221 here. But look at the valuation is only 19.2 times. That's pretty amazing for a company growing at this growth rate. I mean, they're growing so fast. They're the highest end growth company, solid, and they're only at 19.2 forward PE. That's reasonable. Look at Costco, 48 times, Walmart, 40 times. We think there's still great valuation today in some of these AI stocks. Now, here's the other big one is the investment going in. Not only did the hyperscalers, Microsoft, Meta, Amazon, Alphabet, and Oracle deliver in their earnings reports, but they're going to look at how fast growing their investment is in AI. That's off the chart. That's a J curve. And so what we're seeing is they see the future because they're in it. They're creating it. And the future for AI is limitless. But this has been a stock picker's market. You can see out of the 500, 289 underperformed the S&P 500, while 223 outperformed. Fortunately, I would say through the grace of God, we made some really good picks this year, and we're outperforming. We're very thankful for that. But it's been a stock pickers. A lot of companies, the majority have underperformed, but there's many that are outperforming too. So it's a stock pickers market. That's why we are doing a lot of fundamental analysis to pick the right stocks going forward. Now, here's a chart that shows we can see that the performance for the stock market tends to keep going down until you get right before the election, and then it takes off. So as closer we get to the election, it may be not a very big stock market move. Of course, if we get the Iran thing settled, that could send it up, but then it might go sideways or slightly down from there. But we do expect this bump as we get past the November 7th elections.
And just to point out too, like you mentioned, tends to start moving before the election even.
Yeah, I noticed that
Right.
It started historically. This is the historical performance, not necessarily a future
Right.
performance, but it does show that it tends to start moving beforehand.
Yeah.
Tariffs, oil prices, inflation expected to fall. This is an amazing chart. This is by Goldman Sachs. This is Goldman Sachs's forecast. This is the impact, the effects of tariff and energy on price increases. This is really good news. Goldman Sachs, an incredible firm, is saying that by the end of this year, the Iran thing settles, but tariffs impact inflation is going to fall off the cliff. This will all be really good news, and especially with the AI efficiency. This is going to be all good news for inflation going down the road. That's when you may see the Fed shift from holding rates where they are to lowering rates. And when I saw this chart, I got really excited. This is their forecast. Quite amazing.
Very, yeah.
Okay, another good news is that shelter, which is a big component of the CPI inflation gauge, is starting to show that it is coming down. And it isn't fully represented in the CPI, but everything is pointing to that homes and shelter prices are going to begin to moderate and even go down. That's good news for inflation as well. So we think inflation will be dealt with by the end of the year. And of course, the big one is Iran. What happens with Iran and how soon that will happen or not happen. But Iran is a key to this. So hopefully that gets settled. Another positive is the economy looks good. You can see global manufacturing hit its highest since February 22. Service premium, global services, that line is when you're in expansion. Services is made a little bump up to 51.2, but it's still above the 50 line, which is the line going across. And both of them now, because you remember manufacturing was underneath the expansion. That was more heading, to a slowdown. But now we're seeing expansion in manufacturing. Service is still above 50. This is all good news, even while global PMIs are rising. But this is good news for the market. Okay, we do have, Eric, rising worries. We mentioned this. Here's the inventories. The gray area on the right is yet to happen, but the forecast, if things do not change, that by June we're going to have operational stress levels. And September, that's when everything gets really bad. So this is the big key is when will Iran be settled out? And of course, nobody knows, but there are some risks ahead of us if things don't change with the inventories. So here's the other one. We just talked about it. This is just looking at the PPI was hotter than expected. If you look at the far right bar, Eric, and the lower, yep, you can see one. You can see how look at the direction. That was a big bump. We're at 3.79. This is again why the Fed is holding still, why they're not going to lower rates at this point. This is all tied to the Iran war. And here's the big one. You can see, look at the automotive top line there, fuels and lubricants, retail, 369% jump in the PPI. Now the PPI is what wholesalers are paying, not what the retail, but it ends up finally to us every day, spending. But you can see a lot of things have risen, very, very low, especially the automotive fuels. And if we go to the next page, this is, well, what about percent of core PPI components that are growing, that are annualized more than 10%? That hasn't changed much. So there's still a lot of components that's pretty flat at 20%. It's been higher. So even earlier in this year. So that's a kind of an interesting chart, but that could begin to rise if we don't get Iran settled soon. Here's the look at historical Fed chairs when they've come in, new ones. This is the last four, but Greenspan had a correction. You can see the dotted line, and that's when they became the Fed president. It was shortly after markets began to correct. We saw a correction with Bernanke. We saw a correction with Powell, two of them actually. But you can see it happened right after he took the helm. But Yellen had a rally. So this is something. So to me, 3 out of 4 show corrections after a new Fed chair. We'll see if we're in the Yellen camp or the other 3, but it's something to look at. Now let's look at this. This is longer term, but you can see the Fed's balance sheet has come down a little bit, but you can see at the very end, it's starting to tilt back up. We got treasuries and mortgage-backed securities, but that needs to come down to the 2018-16 level. And some things need to change. But if you look at the next chart, which is our current budget, and that top line is the deficit. If it's the kind of a gray, I don't know what color that is.
This one right here, green.
Yeah, well, that gap is what we're spending versus what we're taking in. You can see it's really wide, and of course we now have the Iran war, which is hitting into that, and also the cost of that, $29 billion. So this needs to be closed up. It really does. You can see the last time the line was kind of above was during the Clinton presidency. Hasn't been since. You can see 2020, that was the pandemic. A lot of expenditures in 2020. But this hasn't gotten any better. This needs to change. I'm not sure what the administration's plan is, probably to grow out of it, but we'll have to see. Now, the good news, when you have a high inflation, it actually reduces the real budget, the real deficit overall. Because and some say, hey, inflation's good for lowering your deficit. But these are all long-term, doesn't really impact the current stock market, but it's something we need to watch for over time. All right, well, this is where the rubber meets the road. What's our forecast? First, I want to go to the very bottom, Eric. Because of the Iran war, we have removed Fed cut, meeting 2% inflation target, lower interest rates, deflation, and bond rally. But I want to put this last part, it could come by the end of the year if Goldman Sachs, by the end of December or the beginning of 2027, and if we solve the Iran issue, then this could begin to go the other way. But right now it's off the table. We've been saying there's going to be extreme volatility. We've been very right on that both ways. We've seen volatility to downside, volatility to the upside. That's the missing out. And AI-oriented stocks, especially in that area. We expect the economy to slow slightly, but we expect no recession. Consumers keep spending. The war in Iran, we believe the war in Iran will come to an end. Stocks will reach new highs. Oil prices fall. And then, of course, inflation starts the long journey lower. There'll be a definite lag there. But by the end of 27 or 26 or 27, we could see that. We are still bullish on stocks. We see pullbacks and weakness as buying opportunity. We haven't changed there. Catalysts of the policy support we have with this administration, the big, beautiful bill. We got earnings and growing extremely fast. And we have, of course, AI productivity gains. So we said this earlier that AI stocks will lead again. We are right. They've taken off again. High quality technology, AI benefits continue to dominate. We expect that. There'll be a lot of to the top extreme volatility. There's going to be volatility both ways, but the net is that AI stocks will dominate and outperform everything else. So you can see we've had a list this since the beginning of the year. 3 of our wild cards, potential geopolitical events have happened: Middle East escalation, global shipping disruption, commodity energy shock. So we hit 3 of those. That's why we had to remove all the other below. But this is our forecast. So some of our portfolios are up 15 already. 10 to 15. So we're already hit our target in some of our forecast, which is above the S&P. But this is speaking about the S&P 500.
Right. Can you comment at all? When you say could exceed the forecast, Any speculation on what that could look like?
Yes, and it all depends on Iran.
Ah,
If Iran settles out here within the next few weeks, maybe a month, then we could exceed, especially with the impact that AI is starting to have on companies. And if earnings, and if the market looks through things, it's discounting the future. If it sees inflation coming down by the end of the year, that's just going to propel the stock market higher. We could even go beyond the S&P 15% return.
well, very good. As always, appreciate your message, your presentation, the weight of evidence approach that you take. I don't know if people realize just how valuable this message is. It's just incredible, and we appreciate you for putting it together every month for us. So thank you.
Thank you.
Yeah. So I'm going to open up to any questions. So again, for those of you who are joining us live here today, if you would like to ask Tom a question, you're welcome to email me. You can text our office number. You're also welcome to post a question in the comments section wherever you're watching, if you have that available. I'm going to take a glance here at my email and my text. I'll move a few things around here. So we do have one question about quantum computing and space. And let's see here. Get to the gist of this. So a major tech company has been approved to start providing chips and computers in quantum computing. Wondering when such companies may be included, where you might see that being included, perhaps thematic, maybe the AI. SpaceX, of course, has been in the news. Might be coming out with an IPO as early as June. There could be some hype initially revolving around that. Curious what you're thinking about two kind of broad categories of quantum computing and also space.
Well, let's hit the quantum computing. We've been watching it. It is still very speculative. They have not solved the error problems. It's someone will eventually get there, but they're still not there. Of course, today it ran up big. That will come back down. I wouldn't buy it here. We're looking for substance, and maybe you're not the earliest person into it. This is like a biotech company that's, almost going to get approval for their drug, but it's not for sure. That's kind of where we are with the quantum computing. But once it hits, whoever does hit it, then we'll be in on it. But we're waiting because we think it's too speculative still. It's going to be highly volatile. It's up big today. I think, what is it up, Eric, today? It's up a lot. But it goes back and forth. So we're not ready for quantum yet, but we've got our finger on a trigger to get into it. Now, space, we like space. And actually, we want to get into it. We want to get into it today. We were looking for some kind of pullback. We just haven't seen it. We may take a position anyway because the future is in space. And we would put that, probably there's two places we would put it. ETFs, take a look at the ETF area to capture that in the thematic area. And we may even put it in the sector area, our tactical sector. So we're very close to taking a position in space. We think it's got a long-term future.
And that's a good reminder of that approach, Tom, as you kind of mentioned there, of taking a position in a fund that represents a lot of the companies versus picking an individual company when you're early in a game, like these two areas that you're talking about.
Yeah, space is much further along than quantum, but somebody could have a breakthrough. And if they, that's why the U.S. government recently just invested lots of money in a lot of these quantum, because this is for national defense. For example, if China got a quantum computer really up and active, working well, they would have an advantage in the military. So this is a big thing for the U.S. We think it's a future, but it's like, again, a biotech company. Are you going to get approval from the FDA? That's kind of where we're at.
Cool. Got another one on interest rates, and I think you kind of alluded to your answer, but as you know, we've seen yields going up, and just kind of some commentary on how high you think those could be going here.
I think we could potentially reach 5%. We may be at a top. We're right now, fixed income is struggling. The long-term treasury is down over 4%, I believe, for the year. So all the interest rate, that's why in our fixed alt, we're tilted 60% towards alternatives that are not tied to interest rates. But we think bonds will rally, perhaps, if we can get settled with Iran and inflation. If Goldman Sachs forecast is accurate, we could see it, definitely the last quarter of this year. So we think it's a temporary thing at this point.
Okay, so with that fixed / alternative portfolio, you've got that pendulum swinging between fixed and alternatives. Would you foresee on the somewhat near-term horizon that maybe that pendulum would swing towards fixed, towards bonds, and away from alts?
It could, although we are getting great performance in alts, which can do well in rising or lowering. But that is something we'll take a look at. We could reduce our positioning somewhat. I still like alts for the long term, especially the ones we're in. They've done well. They're doing well this year. But I do like, because you never know where rates are going to go. And I think that having that non-interest rate sensitive components have really helped. And it's helping our portfolio definitely this year versus the aggregate.
Very good. Thank you. I don't see any other questions right now. Let me check one more spot here. Nope. So last call for some questions for Tom. If anybody out there has any, I do see a number of you out there, so appreciate you being here today. I will go through a couple of housekeeping items here. So look forward to and mark your calendars for June 25th will be our next monthly update. That'll be a Thursday as well. We'll be online again, just like we are today. And after we've had the recording to settle here and kind of put Tom's bullet points together, I will have a summary that you'll be able to go to the webpage, hopefully this afternoon, maybe tomorrow, perhaps over the weekend. But nice summary of Tom's message here that you can go to the website right under today's video and download. There's also a button there where you can ask that question if you want to do it very privately. That just comes to me directly. And I'll get with Tom and would love the opportunity to circle back with you if you do have any questions whatsoever. But by all means, email and texting our office number as well works too. If you don't know, I start my week out every Monday morning, 9 a.m. Central Time, with a brief 3, 5, sometimes 7-minute kind of update on what's happening in the markets. Sometimes include some nuggets that we're looking for, and we stream that on all of our different social media pages, just like today, and on the website. So if you'd like to join me, love to see you in attendance on those calls as well. And then later on in the day, 2 p.m. Central, I send out a summary email that includes some more items than what I talk about on Monday morning. So if you'd like that email, you can subscribe at our website. Go right to investwithccg.com. So with that, I'm going to thank everybody again for being here. Take one more glance at my email, text, and I don't see anything else right now, Tom. So one last reminder for everybody, if you are watching in the recording, which I know many of you do, please don't hesitate to send any questions. We would love the opportunity to get those and circle back with you on any questions that you have whatsoever. We really do love your questions. So please do not hesitate, big or small. So with that, Tom, I will wrap us up. Any closing thoughts you'd like to share with everybody? Otherwise, I can.
No, just keep your eyes on Iran. And if that gets resolved, this market's going to go higher.
Very good. Well, as always, Tom, just really appreciate your time and energy that you put into this presentation that you do every month. So thank you very much. Hope you have a wonderful rest of your day, and best wishes to all of you out there in attendance with us here today. Thanks. That concludes this month's Capital Markets Update and Outlook for May 2026. Bye, everybody.